Good afternoon, everyone. Thank you for joining us for our C-Suite Connect during your lunchtime. I'm Billy Zhou, the head of retail research at CGS International, and I'll be your moderator for today's session. Right now, for those of you who are joining us for the first time, let me just do a brief introduction on the C-Suite Connect. Basically, this is an exclusive webinar where we bring together some of the corporate leaders, to join together to basically hear from them directly. They are both from either from the SGX market or from Bursa Malaysia, and we have retail clients that we invite from both Malaysia and Singapore. Right. So the objective is really to provide investors with a direct access to management, offering insights into corporate strategy, industry trends, capital allocation, as well as some of the long-term vision that drives their businesses. All right. So we will have a write-up on the webinar after the session on some of the key highlights that will be available on our research portal as well. Now, today we are pleased to feature Elite UK REIT. Now, it is quite a unique REIT listed on Singapore market that provides investors with exposure to government-backed commercial real estate in the United Kingdom. Now, since its listing, I think Elite UK REIT has built a portfolio anchored by long-term leases to UK government tenants, providing a resilient and defensive income stream. I think more recently, the REIT has been quite active in terms of transforming its portfolio through either capital recycling, lease renewal, selective acquisition, and redevelopment opportunities, right? Positioning themselves for the next phase of growth. So today we have quite a few people here. Joshua, he is the CEO of manager of Elite UK REIT. He has been instrumental in shaping the REIT strategic direction over the past few years, overseeing initiatives to strengthen the portfolio, extend lease tenures, improve capital efficiency, and unlock new growth opportunities. I think more recently, the REIT has announced its proposed acquisition, which we will talk about later on. Right, so we will probably start the session with a corporate video from the company before we pass the time to Josh to do his presentation. Right, so there will be a Q&A right at the end of the session. So stay tuned until the end so that you can actually ask the question directly to the management. All right, I'll pass the time to you guys.
Thanks, Billy. Hey, so I hope everyone enjoyed the video, and I'm Pearl, the investor relations, and I'll now pass the time over to Josh to take us through the presentation. So you should be able to see the slides in a few seconds.
Right. Thanks, Paul. Hi, everyone. I'm Josh. I'm the CEO for Elite UK REIT. I'm joined here by Paul and also Michael, our CFO for Elite UK REIT. First and foremost, thank you very much for skipping lunch or delaying lunch to join us at this webinar. I think this is quite a fair bit to discuss and to present to you some of the latest developments at Elite UK REIT. So I think for those who do not know us, and if you are a bit hungry, hopefully you're also hungry for yield. Currently at our traded price, we are about 9.8% yield, probably one of the most attractive yields you could get for you yourself or for your clients. And that 9.8% yield is also backed by government rentals, which is something that's rather unique in the Singapore market. So our portfolio consists of 147 assets. This is as of 31st March. This whole portfolio is on a triple net basis in terms of leases. What it means is that the government, which is our tenant, pays for everything to do with the assets, be it utilities, governing, operation of cost of running the asset. So you see actually in our financials, generally our gross rental would also be equivalent to our net or quite close to our net property income because there isn't a lot of property level expenses as a result of that. Another fairly unique thing about our portfolio is that most of our assets are freehold or very long, virtual freehold or long leasehold assets. Currently, our portfolio occupancy is roughly about close to 100%, and with a long WALE of 6.9 years. Altogether, we have assets valued at about 460 million pounds. I think if I could jump through to some of the recent acquisition, which I think Billy alluded to, we like the government income profile of our REIT, and we sought to sort of increase that as a result. So we bought 5 properties or announced that we proposed acquisition of 5 properties that we would like to buy, probably right after National Day, once the upcoming EGM gets the approval. But I think what's really attractive about this portfolio that we're acquiring is that it results in longer WALE and also it's DPU accretive. One other thing, it helps us to diversify our underlying tenant. So most of our assets are job centers occupied by the Department of Work and Pensions. Now, this acquisition, I think the largest asset in terms of rental, in terms of valuation, is the property on the top left of this page. Is located just outside Glasgow, and it's leased to His Majesty's Revenue and Customs, which is the tax department in the UK. So very, very strong, tenant covenants as well. And in terms of location, I'd like to delve a bit more. They are located very diverse, I think across the UK, starting from Glasgow, just outside Glasgow, East Kilbride, moving down all the way to the southwest in the Cornwall region. So these assets, you also see that they are bought at roughly about 6% discount to the trustees, which is the REIT's valuers. So this is actually quite an attractive acquisition that we're buying at something that's priced well. And it adds to our government income, but also takes the exposure to the Department of Work and Pensions slightly downwards to below 90%. I think if I could also go into the DPU accretion and some of the investment merits. So this, I think what's quite interesting is that we've not just funded it solely with a equity placement that was in the market. We also, of course, combined with some debt, but also we've gotten the vendors to take shares as well. Last but not least, we have also been doing a bit of a portfolio management, and that has been helpful. So we sold something before this transaction was announced in Q2. So that cash was then cross-deployed to this acquisition. Actually, subsequent to that, about 2 Fridays ago, we announced the divestment of another portfolio, but also that was I think, a sort of a premium to valuation as well. So I think all these would, eventually help to, fund this properly and to bring down the gearing. So as with this transaction, the DPU or distribution yield actually rises about 10 basis points to roughly about 8.5%. And then, the DPU is this transaction is DPU accretive at 1.3%. We took gearing up slightly to 39.2, but with the divestment that we announced 2 weeks ago, that should actually bring it down. At the time of this announcement, that was the second portfolio that was divested, that was recently divested, was not announced yet. So this actually is likely to come down. I think one of the other very attractive reason why we did this is really to have a much longer WALE. So the government, the HMRC, the tax office that we bought is sort of used as a bit of a national call center and a campus for the staff at the tax department. And it has actually a very long WALE in itself, all the way to 21 years to 2047. Now, when you blend it with the rest of the rest of the other 4 assets, it's actually the entire portfolio has a WALE of more than 13 years. So once you blend this with our existing portfolio of 147 assets, our WALE actually increases to more than 7.5 years. When compared against the pro forma date, which was at end of 2025. This year, I think there was also quite a major event that we did around February that we announced that we've actually, re-geared many of the leases, most of them to the 7 and 10-year tenor from 2028. So we're looking at 12-year WALE in some cases. That was a announcement that we made in February this year. So I think the other bit which I alluded to is getting the HRMC, His Majesty's Revenue and Customs, as a new tenant, and it's one way of us sort of reducing the underlying exposure to the Department of Work and Pensions. But all in, whether it's the Department of Work and Pensions or His Majesty Revenue and Customs, all our leases are all with the UK government, just with different departments as the end user, which is quite important. The leases that we sign are really at the national level. They're not at the local level. And these are almost as good as a sovereign credit rating. The UK government, of course, has a very good credit rating from Moody's, S&P, and Fitch. They are around the AA- or AA3 level. Now, these would be credit ratings that will be enjoyed by some of the countries in this region that we're a bit more familiar with, like Hong Kong, Taiwan, and South Korea, are all AA- as well. Okay, then I think just to, I think finally touch on our strategy as the final word before we get to Q&A. So I think when we first started in 2020, when we first listed in February 2020, Elite UK REIT was then known as Elite Commercial REIT. And its sole singular focus was on government leases, mainly to job centers, but also other government workspaces. Along the way, we've tried to, reduce the job center portfolio, but still, with the emphasis on government leases. I think in the April of 2024, we've told the market that we're keen to embark on a strategy to go into student housing as well as to the build-to-rent residential sector, both which are part of the living sector in the UK. Why? Well, there are a few good reasons. One, if we look at what our investors wanted in 2020, it's really a defensive, countercyclical, and non-discretionary sort of, exposure. Now, you look at the student housing and residential, they are also countercyclical in the sense that when there is a recession, people will use job centers, but they also go back to school. So that's quite countercyclical in that nature. They also, very defensive, very non-discretionary in nature. Mean to say that whether there is COVID or no COVID, or a recession or economic boom, these are assets that will be quite used, and still continue to be used. These are not, spending that you generally will cut away. And then I think there are also some strong fundamentals in the markets that we operate with structural undersupply. There is also a bit of a complementary nature between the job centers as well as living sector assets. I think the key one would be location. If you look at the job centers, because they serve the general population, they need to be close to people. They need to be close to amenities. They need to be close to transportation network. In the government white paper in the UK suggests that the job centers need to be within 20 minutes of train or bus travel. Hence, they tend to be, usually on the main street or the first street of any towns within UK. As such, these are very well positioned to be in the future converted into student housing and built to rent residential. In fact, we have embarked on that already. Part of the fundraising that we did last month was also to correspond into the conversion of one of our properties, which was formerly a job center, into a student accommodation. This is in Dundee. And I think we have also in the last 2 years, used certain ways to actually enhance the value of the asset. One of them was this data center land, which I think we are about to market and sell, and that will actually go back into repositioning part of our portfolio. Okay, I think I've spoken quite a fair bit. Maybe we'll go to Q&A.
Hi, thanks for the quick presentation on this. Maybe before we jump into the proposed acquisition, Josh, maybe just have a quick one. Right, just wanted to, so that investors have a bit of context. Like, how do you see Elite UK REIT stands today as compared to when you first joined? Right, could you just give us a bit of so that investors kind of a view
So
on?
maybe I'll start with what hasn't changed. What hasn't changed is our top line of gross rental income. This is government. And actually the government is very good paying after they pay 3 months in advance. So I think over the last 6 years that we're listed, I think the world has changed quite a fair bit. The job centers are still well utilized regardless. Interest rate has spiked up quite a fair bit, and I think every REIT or most REITs in the market, be it in UK or Singapore, are quite affected, and ourselves were as well. So when I joined in middle of 2023, what we were facing were higher interest rates, and the DPU was dropping as a result because your DPU, although the rental is the same, really, you still have to pay finance costs, and those spiked up between 2022 to 2023. And the other way in which REITs are affected generally is with high interest rates. You then see valuation also dropping. So I think with these added factors, I think when we took over, it was quite a stressful time. Valuation fall. The loans that we had didn't move. So what happened, as a result is that the gearing went up to quite close to 50%. So I think then I think in 2024, with the support of our major shareholders at that point in time, we actually did a fundraising to reduce gearing, and on the back of that, Michael and we worked with banks to take a refinancing, to refinance the debt that we have, resulting in better structure for our unit holders, better terms, and also a longer debt maturity.
Okay. I think just now from your presentation, I think one of the interesting aspects is that you are introducing, I think, the HM revenue and customer as a new tenant.
Yeah.
Just wondering how important is tenant diversification? I mean, given that since the tenants are already backed by the UK government, right? Can you give us a bit of context on that?
Oh yes. I think some would say that we are overly concentrated to the UK government, but it is the best risk in the land. And I think it's the highest credit rating you can ever get in all of the UK. The underlying users are also important, but it's not the only factor that we look at. So, for example, when we acquire some of these assets, we also generally want to look at what's our risk appetite. What is the plan B, I guess, if the tenant leaves the building? For example, East Kilbride. Well, I mean, we probably don't have to worry. We don't have to worry about you know the leases because they all signed with the UK government. And for East Kilbride, it goes all the way to 2047. By then, I'll be, I guess, retired. I'll be getting my CPF. Maybe I'll be invested in Elite UK REIT still. But at a point in time, then what is Plan B if the HMRC decides to leave in 2047? We know, for example, that East Kilbride is within a residential area. So I don't know what the world would be like in 2047, but the land values there, for example, would make it very attractive for us as a Plan B. Of course, Plan A is always to keep the government, keep them paying. 2047, the much younger Josh will be trying to re-gear those assets. But at that time, the CEO can't do that for whatever reasons. There is still a very solid Plan B. And that's the same thinking that we have going through any assets that we buy or divest, or what is the alternative use, and what can we get more from these assets.
Okay. And I think the acquisition also increases your exposure to CPI link rental reviews, right?
Yes,
So that
that's right.
that would be better, right? In a sense, I'm guessing.
Yes, actually, one of our favorite questions that we like to be asked is, whether we get affected by, the utilities and inflation. So, especially with the Iran war, and the Straits of Hormuz closing and opening, I've lost track. I think it's closed now. But I think that affects, of course, everybody in the world, ourselves included. Well, I think the first thing I'd like to perhaps highlight is that because we don't pay for utilities, these are triple net leases. It is actually pretty good for us in the sense that we don't have a first order impact. So if you are a landlord of a REIT that that you are in the retail sector or hotel sector, that will affect you very directly. Your electricity bills will go up and all that. So that will affect, I think, some of the other REITs that don't have a triple net lease. So that's something that we have been blessed with. Now, the other bit, of course, is inflation. Now, inflation will affect us in a couple of ways. Firstly, is how the central bank will react. If they increase interest rates to counter inflation, then that will also flow to us eventually. However, I think within the foreseeable future, this year, next year, we're pretty well hedged. Currently, we are about 92% hedged to fixed rates. So actually, that gives us quite a fair bit of certainty for the time being. And then, 2 years later, then I think we have to see what the market looks like at that point in time. But first order impact, very little. We only have 8% that's floating. And but the longer impact of things, the second order impact of things will only be, down the line. But on the flip side, because our leases, almost half of them are, have CPI linkages. What it means is that when inflation go up, although I will be stung on the interest rates, at least my rental will also go up. So these are actually annually compounded from I think there's a floor of 1%. So even if inflation is say zero, we'll still get something in our leases. And then there is a cap of 5%, and these are compounded annually for 5 years. And we'll get these rent reviews, the benefit of these reviews in the fifth year. I think that's generally the structure that we have.
Okay. I think one of the most interesting part is on the student accommodation. I think someone on the floor bring that question up, so I'm just gonna skip to that first.
So,
You guys talk about repositioning Lindsay House into I think about 170 beds of purpose-built student accommodation. Firstly,
mhm.
why student housing?
Well, I think, firstly, I think with if you accept my earlier point that these assets that we have are generally very well located, and I think on the screen right now you see where Lindsay House is. It's really 3 minutes walk up Aberdeen University, up the hill, right? And I think we have a very strong relationship with Aberdeen, but also equally strong a sort of a relationship with the University of Dundee. It is so central to the city that it's almost beside the city council itself. Um, and so location is quite key. Now, student accommodation, of course, you can't have a student accommodation where the property is not within student town. So in those cases, we may look at doing so in if the property is not within a student town, um, then we have to consider other courses of action. In this case, Lindsay House is. And many of the university towns or cities within UK, they have one big university as an anchor. In this case, Dundee it's great. We actually have two big universities. If I could just go a little bit into detail on why these universities are themselves quite attractive. The university sector within Dundee, I think, employs about 1 in 10 people. So it's a very big employer and very big sector of significance to the city. The Aberdeen University is actually very interesting as well. For those of us who grew up playing Grand Theft Auto, that was actually invented in Dundee. Aberdeen University is the best university, ranked the best university for video game development outside the United States. And they have, I think, within the city a big Nintendo DS studio, and all that as well. So it has that sort of very niche talent, which is really the new format of entertainment. The University of Dundee itself as well is very well rated. Although not a Russell Group University, it's probably one of the top biomedical engineering schools within the UK, probably even ahead of Oxford and Cambridge. And you can see on this map, but further west of the city, there is actually a teaching hospital. And that's also very key because if you are a medical student that studied nearby in Edinburgh University of St Andrews or Glasgow, it's a very high likelihood that you end up at the teaching university in the teaching hospital in Dundee practicing for your practical. So this is actually a very good site. Very not far away, really 30 minutes down the across the bridge is the city of St Andrews. St Andrews University, of course, is very famous, very popular with United States students, but also with royals like Prince Harry and Prince William. So I think that's his other fame. If you want to meet a royal family boyfriend, girlfriend, that's the place to be. But other than that, jokes aside, this is actually a very strong city. We are, I think, looking at a market with 3.3 times student to bed ratio. What it means is that there is really not enough supply within the city. So a lot of them actually end up renting from other homeowners. It's quite small, 170 beds, but it is quite a decent size as well. What we're doing here is quite unique. We're not tearing down the building. We're actually gutting out the insides. And we've already done that maybe in second quarter of this year. That was completed. I think last month the main construction companies they moved in and they're starting to build the rooms. They're starting to build the piping and all that. we should be operational and open for business in the 2027 academic year, which is next year, September. So
Oh,
that's
okay.
quite
Quite.
for us.
I think there's the next question is on which university is targeting. I'm guessing it's the nearby in the map, the one that is at University of Dundee, Aberdeen University, and
Yes.
am I correct?
Yeah, we have a very friendly conversation, sorry, friendly relationship with both universities. But we're slightly closer to Aberdeen University, both in terms of proximity as well as relationship. This year, for example, we have started some discussions with them on potentially collaborating together. Aberdeen has seen a increase in their postgrad enrollment as well.
Okay. I think there's another one. I think the first one is probably more for, I think on the cost for investment, I'll ask our team to revert to you, Tina. But there's one on, I think on the listing, there's one is on, I think GBP and another is in Sing dollar.
Yeah.
You want to share the difference just to give a bit of color, like
Yeah.
how?
So I think that's also quite a common question. So thanks for asking the question. So I think we started listed in pounds in 2020. And that has been the case until very recently. In March, we introduced one more counter, menu.fi. That's in Sing dollar. Essentially, they are the same, except the currency is different. So what it means is that when you buy one share, whether you came through MXNU, which is GBP, or MENU, which is Sing dollar, doesn't really make a difference to the Singapore exchange from their perspective. If Miss Tan bought 50 shares using GBP, she paid 34 pence, and then she's also owner of 50 shares. When she sells it, she can choose whether she wants to sell in GBP and Sing dollar. And I think then the SGX then records it as a sale of 50 units. They are indifferent to the currency. But the currency is quite helpful, especially when the unit holders originally have Sing dollar stock capital. So that actually allows them to quite seamlessly go into the investment without having to take one more step to exchange. Although personally for me, the Sing dollar and GBP sort of rates is determined by market. So I think like 2-3 weeks ago, I bought more shares because at this price it's quite irresistible. I've actually personally looked at the GBP, and then I multiplied by the exchange rate and see what the SGD price was at the point in time. And at the point in time, GBP was more attractive slightly. So I went in to buy the GBP, but of course I will have Sing dollars. I could also go straight in Sing dollar if that's more attractive. I think for some of your investors or some investors, they might see that as a very attractive way to do a bit of currency arbitrage, because at the end of the day, that is really up to the market. Now, the last thing I would say about the Sing dollar, and this is something we worked on, I think starting from start of this year, was that we know that it unlocks another avenue of capital, and that's the CPF ordinary account investments. So I think the CPF only allows for Sing dollar traded stocks to access the CPF OA. So we've then started in March to get the Sing dollar listed. And then I think very recently in June, May, we finally gotten CPS approval to include it as a CPF eligible investment. So I think that was another, reason why we did this. And so far, it's still quite young. It's only about 3 months since the SGD counter was started, commenced. But we see actually quite a fair bit of activity, trading liquidity, and it's very encouraging.
Okay, that's good to know. I just want to go back to the student accommodation. I just wanted to know if this is like an one-off opportunity for Elite UK, or is it a beginning of a broader strategy into the living sector?
Yeah, well, some REITs will go into a certain sector or certain market for one asset and then stay quite quiet after that. I don't think that's what we want to do. And when we did this in 2024, it's because we always have this, and as I was sharing just now, we always think about the plan B or some of our assets. So we were approaching a fairly large lease year in 2028, of which we did a major one this start of this year. But when we look at this back in the start of 2024, we needed to think strategically if some of the assets we had a tenant coming out, leaving the properties, how do we backfill these assets? Do we sell them? Do we backfill them? Or do we convert them? At that time, our strategy was fairly singular, very narrow into commercial government. So we wanted to have one more potential exit strategy or potential pathway for conversion. And it didn't make sense for us to go into the other sectors like retail, hospitality, all that. So it is where we define it as at least in the student accommodation and living sector, one as so very very good opportunity. We haven't done it for just Lindsay House. It's too small to really move the entire strategy of REIT. If we didn't see more pipeline down the road, we would just have sold this into a student accommodation developer and let him take it forward. The next project we have identified to the market is in Cardiff, which is a Russell Group University, one of the top universities for research. Cardiff is also the capital for Wales. So I think we are now working on a plan to put it into planning, and we could probably develop about 350 rooms over at our property in Cardiff. So that's the second asset. The third asset, I'll keep you guys guessing a little bit because we're still negotiating the potential exit of a tenant. And once that's announced in the market, I think the whole plan will be reviewed, I guess, why we did this in 2024. We have been planning ahead.
Okay, looking forward to hear more about that. All right, just want to look into the funding portion. I think the proposed funding combines debt consideration in its private placement and all that. Just wondering, I mean, most investors naturally will worry about dilution whenever new units are issued. So how do you think investors should think about the trade-off between the dilution today and value creation over the long term for Elite UK REIT?
Yeah. So I think that's a very good question. We had some of these questions along the way, informally as well as formally. So I think it's important to take a step back and look at all the rationale, all the investment merits for why we're doing this. I think most people would, I think so far all we spoke to are quite positive on the acquisition. They think it's the right thing for us to do. There are, I guess, certain trade-offs. When we look at this, I think the first questions we usually will have to ask ourselves, what's the best way to raise this funds? Is it debt? Well, there is a certain limit where we can push the pedal on the accelerator on debt. Because, I think, as I mentioned, we had this history in 2023 where we had to deal with the leverage. So we worked quite hard in the last 3 years to bring the gearing down to sub 40%. So it's something that because we have worked hard for it, it's something that we're not very prepared to push gearing above 40% again. That's why I think it was finally balanced. The debt, we're not going to overdo it. I think as a result, then the rest of it is going to be equity. Now, on the equity side of things, consolidation units, I think really helps us to reduce the ask from the market. When someone could give you money, I think that there is a positive. Of course, it's at what pricing, right? Then I think the last thing that we had to consider was do we do it as a private placement or a rights issue or a preferential offering? Essentially, preferential offering and rights issue is the same thing, goes back to the unit holders that are existing, and the private placement goes to new and non-substantial unit holders. So I think for us, we ultimately chose a private placement, which is a bit more typical for smaller deals. Had this transaction be far more larger, I think we would have done also a private issue offering.
Okay. You talk about, you're not so prepared to take your gearing level above 40%. Is there any target that you guys are looking at? Like, is it 40 is the max, or is there a certain level that?
Yeah, so very good question. I think we have been saying it actually for 3 years, but I think in Q1 our results, I think we started to guide our analysts started to guide our investors that the gearing that we are gunning for is 35 to 40%. So I think we've said that to the market, and that's something we're really quite comfortable. I mean, the world is still quite a dangerous and volatile place at the end of the day. Having that 10% buffer is definitely good to keep it in our pockets.
Okay. I just want to ask, since you guys are operating in UK, just wondering what are some of the best UK properties opportunities that you guys are looking at?
Well, the government sort of sector is actually very deep. I think whilst we look fairly unique in Singapore, because firstly UK, but the other sort of very unique point is that all assets are government assets, right, or government derived income. There are about 30 REITs on the LSE, London Stock Exchange. One of them is holding hospitals, medical clinics that's leased to the UK government. So they are a bit like us, except the underlying probably is different. But the money source is the same, it's the UK government. So there is a portfolio like that. The other REITs, I think there are a couple of them listed on the LSE that are social housing REITs. So it is where I think we don't really have social housing in Singapore, but they will be probably close to like 2 HDB or 2 HDB flats. But those are usually provided by the government for people who sort of need them. But they actually rented from the private sector, REITs in fact. So we yeah, sorry. So they also do get government income. And then, of course, when we bought some of these properties, they were originally sourced from other non-listed private developers. So that sort of market is very, very deep in the UK. Just very foreign from Singapore's perspective, but actually it's more for us to buy. The asset that we bought last year, for example, we bought 3 assets. Two of them was leased to the Home Office. Very interesting asset. I visited one of them as well. They used it to dispatch investigators to the shore when there are asylum seekers coming to the shore to make sure that they're not being sort of used by the crime syndicates. And then sometimes they collect weapons, cash, and drugs, and those are stored in our facility. So that's also very, very, countercyclical. I mean, it's defensive, but government income. I think we also bought one asset from the DEFRA, which is the Department for Environment and Food and Rural Affairs, which is, I guess, a bit like the AVA in Singapore. So all these assets are traded. We've got other assets. I think if you could show the other tenants, we've got other assets with the Environment Agency, the Ministry of Defense. So I think we are barely scratching the surface. We did start with a DWP portfolio, but I think we're slowly sort of going into other asset classes. But I think at the end of the day, these have to be assets where there is a viable plan B, right? And also we know with a reasonable sort of guesswork that the government's probably going to be staying quite long in some of these assets.
Okay. Thanks, Josh. So usually I let the presenters to talk about the growth opportunities and prospect and all that before I end the session asking you what are some of the key risks that investors should really pay attention to, so something that we should look at as we invest into Elite UK REIT, so that something for us to prepare.
Yeah, sure. So maybe on the do you have a slide on our objectives, our key priorities? I think that could be one good way to sum it all up. So we use a quite easy mnemonic called the 5 R's. That's really the things, and the things that we look at as a management team for the next 12 months on things that we want to do. Give me a second. So while Pros is sharing them, maybe I just list them down. So number one is media, and you can find this in our Q1 slides, but essentially we've said the same thing in different ways, in different pictures. But the first one is media. So I think this year, as I mentioned, we had a very big event where we get 70% of our leases. But we still have another 30% to go. Within the 30% to go, it's probably 20% more, and 10% we think will become vacant, which then I think it's a very good way for feeding that vacant stock into some of the repositioning activities, such as Lindsay House, which I just mentioned, but also other asset opportunities. Blackpool is a very opportunistic case where we had a very oversized property. So the government stays on 1/3 of the property, with the other 2/3 is really just grass, overflow, car parking. We saw that there was a very good opportunity because I think that the area has a lot of power from wind and nuclear. It has a new data cable that comes from the United States. So we found that that was very attractive for it to be repositioned. What we did was we got 120 MV of power. Then we went to apply to the local council for a change of use. So both have been obtained. I think we're working towards trying to sell this year or next year. Again, that money is the value add opportunity is a very good case study where we are repositioning an asset. It doesn't need to be within our core focus because we're not holding it, we're just selling it. But I think the value creation there is very attractive for us to either pay down debt or to buy other assets that are more yield accretive. Now, then I think the other thing that Michael is going to be very busy with is to do the refinancing, and I think continuing to try to optimize our debt capital, but also trying to go into different sources of funding and to stagger our debt maturities going forward. So I think right now 90% of our rates are fixed as well, so that gives us a very good starting base. But with this lease review, which is the first point again, that really puts us in a very good starting point to talk to our lenders to say, hey, would you like to extend your debt, and also can you also reduce the interest rates? So I think all these are things that we're working on this year as well. The reconsidered point and the fourth point from the top, that's really to divest and reinvest into more accretive opportunities. So they're all quite linked, as you see. For example, if we sell Pure Park, we want to move that into more yield accretive opportunities. But notwithstanding that, I think this year we will see more portfolio management objectives. We really sold 5 properties this year, and all at above valuation. And these will go into opportunities such as these 5 properties that we recently acquired. Last but not least, and I think we've done quite well here, but of course can still do better. We've got 8 equity analyst coverage, including CGS. We've started to be included in an index at the start of the year. I think we'll probably, hopefully, fingers crossed, have 1 more or 2 more this year. And I think these sort of opportunities like this webinar is a very good way for us to reach out to our investors.
Okay, thank you, Josh. For those of you who wanted to read the report on Elite UK, you can actually find it on our research portal. I think that's it for today's session. Thank you, everyone, for joining us. Thank you for the presentation and the answers. Appreciate it, guys. Thank you. Bye.
Bye.